A Ponzi scheme is a type of fraudulent investment scheme where returns are paid to earlier investors using the capital of newer investors, rather than from profit earned by the operation of a legitimate business or investment. This creates the illusion of a profitable enterprise, when in reality the scheme is unsustainable and will eventually collapse when there are not enough new investors to pay returns to earlier participants. Here's how a typical Ponzi scheme works. Attracting investors. The scheme organizer promises high returns with little to no risk. These returns are often much higher than what is available from traditional investments, which can lure people in. Initial investment. New investors contribute money, believing they will earn large returns. The organizer may even pay a small return to the first investors to encourage them to reinvest or bring in more people. Paying returns to early investors. Instead of generating profits through legitimate investments, the organizer uses the money from new investors to pay returns to earlier investors. This creates the illusion of a successful investment, which further attracts new investors. Expansion. As more people invest, the scheme grows larger. The organizer often uses marketing tactics, word of mouth, and promises of financial freedom to continue attracting more and more people to join. Collapse. Eventually, the scheme collapses when it becomes difficult to recruit enough new investors to pay returns to the earlier investors. The organizer may also take off with a portion of the funds, leaving many investors with significant losses. After the collapse, many investors are left with significant financial losses. Legal actions may be taken against the organizer, but recovering the lost funds can be challenging. It's crucial to be aware of the signs of a Ponzi scheme to avoid falling victim to such fraudulent activities. Now that we've explored what a Ponzi scheme is and how it operates, let's delve into some real-life examples that shook the financial world. One of the most infamous Ponzi schemes was orchestrated by Bernie Madoff. Madoff's operation defrauded thousands of investors out of billions of dollars, making it one of the largest financial frauds in history. Investors were promised consistent and high returns, but in reality, Madoff was simply using new investors' money to pay off earlier ones. When the scheme collapsed, countless lives were ruined and Madoff was sentenced to 150 years in prison. Another notable example is the scheme run by Charles Ponzi himself. In the early 1920s, Ponzi promised investors massive returns from international postal reply coupons. While the scheme initially appeared successful, it was unsustainable, and Ponzi's empire eventually crumbled, leading to his arrest and the coining of the term Ponzi scheme. These examples serve as stark reminders of the devastating impact such schemes can have on individuals and the economy at large. Always be vigilant and skeptical of investment opportunities that seem too good to be true. Now that we've explored what a Ponzi scheme is, how it works, and real-life examples, let's talk about how you can protect yourself from falling victim to such schemes. First and foremost, always do thorough research before investing your hard-earned money. Look into the company's history, its management team, and any available financial statements. Be skeptical of investments that promise high returns with little to no risk. Remember, if it sounds too good to be true, it probably is. Another crucial step is to check if the investment is registered with the appropriate regulatory authorities. In the United States, for example, you can verify this with the Securities and Exchange Commission, SEC. Registration doesn't guarantee the investment is risk-free, but it's a good first step in ensuring legitimacy. Lastly, seek advice from a trusted financial advisor. A professional can help you understand the risks and rewards of different investment opportunities and provide an objective perspective. By taking these precautions, you can significantly reduce your chances of falling victim to a Ponzi scheme and protect your financial future.